The Community Reinvestment Act was passed in 1977 by the Carter administration to address the horrible practice of redlining. Now, redlining was used to identify communities where low to moderate income residents resided. The objective was to deny access to mortgages, loans, insurance, and other financial products. The result was that this denied Black and brown families the opportunities to purchase their own home. Because most families derive their wealth from their homes, low to moderate income African American and Latinos were denied access to viable forms of credit and the ability to create wealth. On April 9th of 2019, the Subcommittee on Consumer Protection and Financial Institutions for the House Financial Service Committee held a hearing to determine whether the Community Reinvestment Act needed revision. Both sides expressed a deep desire to make modifications to the law, given the advancements in technology and other pertinent changes. The following video demonstrates the importance of this law and the things that the community needs to be aware of.
This hearing is entitled the Community Reinvestment Act, Assessing the Law's Impact on Discrimination and Redlining. The work of our subcommittee is critical because we consider the complexities of an evolving banking sector enabled by rapid developments in technology and critically important issues of consumer protection. Today's hearing is an example of these opportunities and challenges and the importance of not losing sight of our obligations to American families, small businesses, and the least fortunate among us.
I'm glad we are having this hearing today to discuss how banks meet the credit needs of their local communities. Throughout my career in the financial services industry and my time in Congress, I've championed access to credit for all individuals and businesses. Banks should not decide to make loans based on the gender or race of an individual and should not deny loans to individuals based on the neighborhood they live in. It is the role of banks to take into account creditworthiness to determine if an individual business is eligible for access to financial services. While the vast majority of banks work very hard to support and serve their communities, the truth remains that too many Americans are either unbanked or underbanked.
CRA is one of the most important and impactful civil rights laws applicable to federally insured banks. Enacted into law by Congress in 1977, CRA addresses how banks meet the credit and capital needs of the communities they serve. CRA was passed in response to redlining, a pernicious practice by which banks discriminated against prospective customers based primarily on their racial or ethnic background and where they live rather than credit worthiness. However, recent data compiled by one of our witnesses finds discrimination in lending continues to be a problem, and redlining continues to be pervasive in more than 60 metro areas across the country. In addition, in 2018, bank regulators gave 98% of banks a passing CRA grade. There's a clear disconnect, and these outcomes are simply unacceptable. CRA must be strengthened to ensure neglected communities are fully and fairly served by banks that enjoy the backing of all U.S. taxpayers. Furthermore, policymakers should strive to strengthen CRA's legal framework and explore ways to improve how it is implemented and administered.
And while the objectives of CRA are not a relic, the means to reach it are, in fact, antiquated in our current marketplace. Today, the CRA is an analog approach to a digital world. 95% of Americans own a cell phone. So you can no longer measure a bank's commitment to its community based on the number of physical branches. So we can and we should do better. This should be a bipartisan understanding that we have. So we should do more to ensure that there is equal access to consumer credit. There are, in fact, banking deserts in this country, both urban and rural. So while the goal of the CRA is laudable, the results aren't quite as sterling as we need them to be.
I want to start by saying that CRA has been effective. Federal, academic, and NCRC's own studies have documented the way CRA has increased the provision of mortgage loans, small business loans, investments, and other financial services in low and moderate income neighborhoods and to low and moderate income people. But measuring CRA's impact involves proving a counterfactual, what would happen if it didn't exist. The Federal Reserve Bank of Philadelphia found that a loss of CRA census tract designation leads to a 10 to 20% decrease in mortgage lending, and we see a similar thing with small business lending. Conservatively, we estimate a $52 to $105 billion loss or shift in lending in LMI areas nationwide were CRA to be significantly weakened or assessment areas transformed.
In passing the CRA in 1977, Senator William Proxmire stated that the act was based on the widely shared assumption that a bank's public charter conveys numerous economic benefits, and therefore it is fair for the public to ask something in return. The underlying theory of the CRA is that banks have duties to the public because they benefit from significant government subsidies. This bank-government social contract seems to have been forgotten entirely. Banks enjoy a monopoly on the Federal Reserve payment system, receive subsidized funding through FDIC-insured deposits, make loans supported by federal guarantees, and invest in mortgage-backed securities markets enabled by GSEs. And all of this still doesn't cover the bailouts when the industry fails, or the unprecedented monetary policy actions of the Federal Reserve, including trillions in quantitative easing. Banks need this support, without which their customers would lack sufficient trust to permit them to function properly. For trust is the currency of banks. In return, banks are to serve as the engines at the center of the economy. They provide credit, financial services, and liquidity. It is their role to connect the people to commercial markets and administer government credit policy and monetary policy.
To be clear, the CRA is one of the most important civil rights and economic justice laws of the 20th century. In the 21st century, however, the law is in dire need of reform to better serve low to moderate income communities. CRA-regulated institutions have not always met the needs of their communities, allowing an array of non-banks to enter the marketplace, many of which provide high-cost and often predatory products. Both advocates and industry agree. The CRA can and must do more.
While the CRA has made great strides in ensuring access to credit in low and moderate income communities and among minority and low-income borrowers, systemic economic and social challenges remain, perpetuating a lack of access to fair credit services for many and allowing predatory providers to thrive. Given growing economic inequity in urban, rural, and Native American communities, it is important to get CRA right.